word of the day is two. This is Overtime. I'm your host, Chris Vecchio, head of Futures and Forex here at tastylive, joined, of course, by Ilya Spivak, head of Global Macro. Ilya, the word of the day is two because this has been the biggest two-day decline in the NASDAQ thus far in 2023.
We said the Fed wasn't going to have an impact, right?
I guess not.
I guess not. Wrong. Yeah, this is quite a thing, and it comports nicely because what we got overnight was two more central banks that ran away. We just had Bank of England and the S&B both going, no more rate hikes.
The Bank of England one was particularly surprising. Not only did rates markets have a hike effectively priced, and it was a coin flip when you looked at overnight index swaps, but the consensus forecast was for 7 people to vote for a hike and 2 for a hold. Yeah. Instead, you have 5 people vote for a hold and only 4 vote for a rate hike. Mm-hmm. I guess we were right about Andrew Bailey when he said that he was pretty much done with the rate hike cycle from his perspective in front of Parliament. He convinced a number of other policymakers to join him there as well. But that, to me, is not the story in these markets today. It's the move higher in Treasury yields, up to fresh cycle highs. Real yields are extending higher, and stocks are taking it on the chin. Although my argument today on Futures Power Hour was that this is just what happens when interest rates go up. Our discounted cash flow model, cash flow is divided by 1 plus the interest rate in any given period of time. Well, if you increase the denominator, then the value is going to get lower. And so when interest rates tick up across the curve, when expectations for where the Fed's going to move across the curve, well, then the future value of cash flow goes down, and therefore equity prices need to get pegged to a lower level. And boy, did they ever. S&P 500 down 1.75%, 43.67 right now. NASDAQ off by 2%, 14,848. Russell down 1.64%. 1796.5. Dow Jones up by 1.18%, 34,319. Ilya, the banks do pretty poorly today. KRE is down by 1.45%. First time in a little while that KRE hasn't underperformed the Russell, so I suppose that's the bright spot. AI, bots ETF down by 2.51%. We were talking about this yesterday on the show. At least we got one thing right, that it looked like we were seeing a more considerable breakdown just get started here in those tech names. And yes, indeed, it did. Ilya, I suppose we should start with the yield story, though, because this is a tale of two cities, as it were. 2-year yield yesterday closes at 5.08%. Today, it hits a high of 5.168% and then only closes at 5.089. So the front of the curve doesn't really do all that much. Neither does the belly, but it's the long end that gets walloped here today. ZZB off by 2.19%. That's 2 full points lower. UB off by 3%, nearly 4 full points. That's 3 and 24/32. Let's pop on over to that 30-year yield. This is, I would say, ground zero for much of the market pain here. 4.546%, here on that 30-year yield. What's going on? Why is the market all of a sudden acting this way? Is it simply because of our thesis yesterday that the market was going through a repricing around, 2 fewer rate cuts? We need to readjust our expectations on interest rates now in the bond market moving forward.
This is an interesting situation. It's an interesting situation for a whole host of reasons. The first, of course, is that we don't see nearly as much movement at the front end of the curve. So what we have is steepening, but the steepening tends not to be at the front end where the most sensitivity to Fed policy is. That was yesterday's move. So what this is pretty interesting in the context that we have a situation where the front end is holding, it's the back end that's moving. So maybe this is some of the cuts coming out of the forecast and the market saying, you know what, it's not like more cuts will then appear. And if more cuts then don't appear, what this seems like is a soft landing kind of narrative, unless you look at equity markets, which are getting squeezed to death. But maybe it's because the Fed forecast was all soft landing minded. It's an interesting thing because what that doesn't comport with is all the other indications around the markets. And I'm particularly looking at you here, Japanese yen, because the yen is surprisingly well supported here on a day when yields are surging, which is an interesting thing for it to do. And that seems to speak to risk aversion. So there's a narrative here where there's a stronger dollar, there's a stronger yen, there's weaker stocks, all of that lines up. But why the front end is so anchored when the back end is surging, that's an interesting question, and seems to suggest that the markets are afraid of what the Fed may think it's doing.
When you said, what the I was like, wow, Ilya, this is a family program. I can't believe you're about to go there and just curse like that. But one of the reasons why it's a family program... I do try to
contain myself, but only for the 90 minutes that I'm live on air.
One of the reasons why it's a family program is because we get to have Dylan Ratigan join us here, coming in from Milan, Italy. Hopefully we don't surprise him by now asking him to turn on his camera. Ryan, you can bring him into the room. And hopefully Mr. Ratigan, dare I say, is not of the mindset that I am to be blamed for what he did today in the market. Dylan, tell me you were not selling puts today.
Listen, can you people hear me?
Yes,
yes.
sir.
Can you hear me?
Absolutely.
Chris? Ilya?
We can hear you. I
Hello?
don't think you can hear us. While Dylan figures that out, let's talk more about this yen move. Ilya, tonight we have a Bank of Japan that's coming into this market with, I don't want to say, super high expectations to do something, although the rumors are afoot. The BOJ is getting
moving
ready
over there.
It has been.
Suggesting the markets are sniffing around for something.
Well, this leaves us with a very interesting proposition for the yen today.
Yeah.
At least going into tonight. Because if the BOJ does not offer a signal that they very well could be exiting their extraordinary stimulus efforts sometime soon, the table is set for the yen to get walloped tomorrow. Gold is down.
Maybe.
Meaningfully. U.S. Treasury yields are higher. Although gold had a really interesting day. It finishes about 1.4% lower here, 1939.8. Reversing much of yesterday's gains, although I would argue, Ilya, if a week ago I told you that the 10-year yield, the 30-year yield would be 20, 30 basis points higher than where they were in a week's time after the Fed, where do you think gold would be? Saying that it would be $7 higher than where we closed last Thursday, I don't think would be on the bingo card.
No, and this is exactly what makes this so interesting. I think you've hit the nail squarely on the head. Mm-hmm. If we're talking about yields are surging because the market looked at the Fed summary of economic projections and said, oh, goody, they're pricing in a soft landing, would we be seeing what we're seeing here with gold and yen? Probably not. So,
Ilya, while you're speaking, I just want to
that way.
Try to get Dylan back in here, see if his audio problem has been fixed. Ryan, we'll do it live. Bring him back.
Yeah.
Can you hear us?
Can you hear me? I got you.
Yes, we can hear you. We can see you. Dylan.
This is just building suspense. All of this is just theatrics. I'm using the technology to build anticipation so that you understand, Chris, whether we can allow you to keep your CFA.
I suppose then the question is that you didn't hear before. Tell me after yesterday's discussion, you went back.
Rose up. Amazing. What is going on today?
But you can still hear us. So I'll ask the question. Did you go back to selling call spreads in the NASDAQ?
So, no. What happened was I took the moral victory of being right because I've been doing it for a month. But because I had the put spreads on from yesterday, I did take a beating. But I took some financial losses, but I took a moral victory, and I feel quite confident with the entire situation. Listen, no one ever said that I was the world's best trader. Just because you're right doesn't mean you can't be wrong. And so I got a little bit wrapped around the tree with the spreads, I will say, but nothing that I won't recover from. And at least I'm happy to see the rational reality of price reduction come into play.
I mean, this is definitely rational, right? Our conversation yesterday was there's a repricing going on in the stock market thanks to higher yields. I do go to my CFA textbook and I look up how is equity value, determined. It's based on a company's, cash flows at the heart of it. And if you're going to look at a discounted cash flow model, then higher interest rates mean the future value of cash flows will be lower. So the residual value of equity should be pegged to the downside. Sure enough, there is a very sharp move here in interest rates over the past 24 hours. We're down 2.6% in the S&P 500 since Powell started speaking yesterday. We're now 3.3% lower in the NASDAQ over the past two sessions, the biggest two-day loss in tech stocks that we've seen in the course of 2023. It wasn't a good 24 hours for markets here. My question is, though, how much further?
You want to know why I thought it was good, Chris?
Sure.
Because I felt like it's been irrational. I'm like, are these prices connected to reality? And for me, at the very least, as you guys really very clearly articulated yesterday, there was a material change in future expectations, even if it's semi-abstracted through the view of, future rate cuts and when they'll happen and how many, which is inherently a changeable thing. But it changed, the expectations changed for today, and the market responded. I argue that that's a sign of health. I'm more nervous when it just seems it's indifferent. Where you're like, at least I was perceiving it to be more indifferent.
I agree.
Anyway, yeah,
I agree completely. I mean, I've been waiting for this through the entire first half of this year, basically expecting that this reckoning would come. It's come later than I thought it would, but it appears to be here.
It's funny how things change over time. 14,862 and 3/4. We were here back at the beginning of June, and everyone was quite happy because we're coming out of a situation where we avoid a debt default. And look, markets are sitting up near all-time highs. And now we are here in mid to late September, and we're at 14,862, and people are saying this is a really bad day and a really bad setup for markets. I suppose, Ilya, I have to give you some credit here. I can't help but feel like the market reaction here the past 24 hours revolves around the idea that we are heading towards a deeper economic setback.
Yeah, I think so.
To Dylan's point yesterday, he said you're kind of trying to outsmart yourself when you explain, well, if interest rates are higher in the short term, that reduces credit availability, which then in turn hurts the economy longer, which means that interest rates need to come down at some point in time. But let's just go back to your point here. If the market was hunky-dory with the concept of a soft landing, right? If we were all on board with that, then the Fed telling us that we were going to get 2 fewer rate cuts next year, we would have digested like that and said, not a problem, because the economy is so strong and you're not going to need those rate cuts. Instead,
the markets would cheer. They would go,
the markets would cheer.
Oh, good.
Instead, the markets, instead the market's saying, so we're not going to get those rate cuts. We're looking at increasingly despondent economic data on the fringes in the United States, but particularly worldwide. And so the odds of the Fed having just made a mistake increased here. Generals are always fighting the last war. Generals are always doing the thing that they should have done in the last fight. And the last fight for the Fed was they should have raised rates sooner. They kept rates too low for too long. Inflation on a long enough time horizon, of course, is transitory, but in the window with which they prescribed it to be transitory, it was not. And so the market is looking at this today and saying, you folks are going to leave rates too high for too long now. It's going to bring about economic calamity. It's going to cause more problems. Credit card delinquencies are up. Auto loan delinquencies are up.
Yeah.
We now have a greater likelihood of seeing a more significant recession next year. Plain and simple. And that's going to hurt corporate earnings. So not only are cash flow expectations falling, we're also seeing that the denominator in our equation, interest rates, are going up. And when numerators go down and denominators go up for discounted cash flows, that means that equity values have to come to a lower level. Plain and simple. It's just arithmetic.
But there's that CFA acumen right there.
Still exist. I mean, again, 2 days ago, where they were talking about many good things, and I'm just a little bit hesitant to go, even though I'm the first one on the bear train around here in terms of rates and real estate and operating costs from energy prices and on and on and on. But the optimistic tale of one being the best house in a bad neighborhood of the world, as well as AI, EV, payments. I mean, all those things haven't gone away. So I don't know. Now
I think all of those things hold.
The whole thing's flipped. The whole script is flipped around on us. Sorry, Elliot.
Oh, no worries. I mean, I think all of those things remain. It's just a question of sequencing and timing. It's just a question of when,
and pricing.
Yeah, just a question of when the revolution comes. Just because it may not come in the next year or two doesn't mean it won't come. This is a long tail kind of thing.
Ilya, we were talking before Dylan came on about the relationship that's unfolding right now between the yen and yields and gold. Dylan, my perspective has been, and this is informed by, the data. If you look at gold, for example, a precious metal, which I'm going to pull up on the screen here in a quick second, it is a dividendless asset. It's a cash flowless asset. There's no coupon attached to it. And so it does best in environments defined by negative or at least falling real yields. Yields, nominal treasury yields adjusted for inflation. This time last week, gold prices closed at $1,932.80. If a week ago you had told me, Chris, next Thursday, the 10-year treasury yield is going to be 20 odd basis points higher. The 30-year treasury yield is going to be 20 to 30 basis points higher. The 2-year yield is going to be north of 5%. The dollar is going to be stronger. I would have told you that gold prices should be lower. And yet here they are, $7 above where they were a week ago. So yeah, gold came down. It had a poor day, down 1.4%. But it's still performing better than I would say that my models, both mental and Excel, tell me it should be. And so if gold's performing better than it should be, if the yen is weathering the storm, it's one of two things. I have every single futures product that I talk about or trade or have traded up on my screen here. The yen is literally the only thing. Crude oil is now down by 0.03% of the session. So the yen is the only futures product that I look at seriously that has a green number next to it. That really makes no sense. Ilya, can you expand upon that? And I suppose we can then get Dylan's opinion on what you said.
Sure. So when you get a rise in yields, the yen should fall and has fallen basically for years and years and decades and decades.
Why is that the case, though?
Sure, because interest rates in Japan have been next to zero for decades and decades and decades, because since the 70s and 80s on to today, they have had a consistently shrinking population, first a slowing of population growth, now an outright contraction of the working age population in recent years. An older and shrinking population doesn't consume. Consumption is what drives growth. Growth is what drives inflation. They've had structural decline on all of these metrics for decades. And of course, that's self-defeating, because if you expect the price of things to be lower later than today, well, that disincentivizes you from non-essential consumption even more, because you might get a better deal later versus now. So any notion of pricing power has been completely drained out of Japan for the longest time. And the Bank of Japan has kept interest rates rock bottom to try to revive it, to try to gain some kind of momentum in the economy, again, for ages and ages. What this gave birth to doing in the markets is the carry strategy, where essentially people go and borrow yen for next to nothing, go buy things that yield more, and extract that yield differential. What happens when interest rates stop rising everywhere and go in reverse? They haven't gone in reverse yet, but we've now heard from, 5, 6 major central banks that have gotten cold feet. Most recently, Bank of England and the S&B overnight. ECB.
Bunch of chickens, I say, bunch of chickens.
Well, there you go. So at this point, most of the G10, minus Japan that never raised rates for the reasons we've just said, are running away suddenly from the rate hike cycle. So what you tend to see in those situations is the markets go, okay, so the expansion in yield spreads against Japan is probably over. So time to exit these positions. So they sell whatever they bought with borrowed yen, and then they have to cover those loans, which means they have to get back the yen and cover them. So there's yen buying that necessarily tends to occur as these things are unwound en masse when interest rates after a rising cycle stop doing that. So if what we're seeing today comports with risk aversion tells you central banks are running away for a reason. There is some sort of a recession or an economic downturn on the horizon. The translation for the yen is, okay, unwind yen shorts. And so to see the yen higher here is a very potent bit of confirmation that the market is scared of something, that they think central banks are done. That, of course, comports with lower stocks. That comports with a stronger dollar, which we've been saying over and over again is something of a beneficiary to liquidation because it is the most liquid form of cash. What's really interesting about all of this, as we were just talking about a second ago, is the market has all the hallmarks of being afraid of its own shadow, but it's longer dated interest rates that are surging today, and the front end is holding. So the market is seemingly saying the Fed is about to make a policy mistake, and that's a bad thing.
Ellen, your response?
No, yeah, I'm just thinking about, what I'm thinking about is, one, the idea that the market frequently has no memory from one day to the next, which is sort of insane. But it's obviously, this is a great example of that. And what I was thinking was just about the dynamics of risk off, and just how, to me, the stronger yen is a very clear confirmation of a risk off sentiment.
Yes.
Which I would then think would go, Chris, to your perplexation, if you will, regarding the behavior of gold prices, which benefit from the risk off sentiment structure, even if they are, there are other reasons why you would not think that gold would have held that price level. I would presume that gold, like the yen, benefits from a risk off.
For the same reasons.
Yeah, it's the exact same event. The interesting thing, because again, now so clearly I'm like, okay, finally, I was early, whatever. Not to be so self-referential, because it's such a, it's chicken feed, but. The question I asked myself is, okay, because what happened was I was very confident a month ago that this market's going to be going in a slow to accelerating degradation, really, for the rest of the year. And then it didn't happen, right? That there was a press, NVIDIA earnings came out. NVIDIA had a little moment. Tesla did some things. All these the things had happened, but now obviously we're in a hard roll here. It's just a matter of it's such an interesting. The reason the stock market is so fantastically, delightfully, fabulously fun is that you can analyze it forever and ever and ever and ever and ever, but I defy you to really know what's going to happen on Monday.
Oh, nobody knows.
It's amazing. And you can have so much information, so well informed, and yet clueless.
Well, I will say,
to play chess on a liquid surface is the funnest part of this whole thing.
Yeah.
I will say that from a technical perspective, the red warning lights, Danger Will Robinson, definitely is coming across my screen today. The uptrend that carried us higher for most of the year, January, March swing lows in the NASDAQ, that's lost today. When we look over at what's happening in the Russell here, RTY, continuous contract for the sake of this conversation, that range that we were in March, April, we finally broke through the beginning of June, which then 1830 or so, we'll call it 1830 to 1850, becomes support in June, July, August here. Yikes, we're back in that consolidation. Rule of thumb, if you break out of a consolidation only to return into it, you typically see a move to the other side of the consolidation, 1700 or so. S&P, here's another red flag for you. Now it's breaking its longer term uptrends, really no matter how you slice it, although here in ESC3 perhaps is better suited for this conversation. Not only do we lose the uptrend from the September 2022, March 23, August 23 lows, we also clear out the August swing low here. So if you're one of those head and shoulders people, oh, there's your neckline break starting to come together.
Yeah.
And this neckline break points to a measured move down closer to 4,100 here over the next few weeks. This is typically a bad time of year for stocks. August, September, you see vol rise. September, October, you see weakness in stocks. Matches up with the seasonality. We talked about the Rosh Hashanah Yom Kippur window where stocks typically decline as is. The stars are aligning. We're seeing a tendency to hew to the seasonal effect, which is whatever reason, markets like to go down at this time of the year, and boy, are they going down. If you haven't been trading this directionally, you may say to yourself, well, I missed the boat. I don't know that to be the case. The momentum profile has turned much more negative here in recent days. We're outside of ranges now. The NASDAQ looks like it's close to a range break. And so if you are like Mr. Ratigan and you've had the proclivity to trade these markets from the short side until recently, I would say that maybe it's time to reconsider that perspective. Vol has moved up, which
hold on, meaning that you might want to lighten up that the short action has played itself out.
No, I'm saying that the short action
is about to start to play itself in deeper and harder.
Well, I'll just look at this. Here's your high. Here's your low. Here's your lower high. Now we have a lower low. I think Ilya would call this the beginning of a more concerted downtrend here. Even if we think about this,
it closes, yes.
Even if it doesn't close down here, we've now seen a lower low relative to August. So to suggest that this is a market that we should be trying to, catch the falling knife on directionally, so to speak, I don't know that's the case. Vol has expanded though, which is pretty nice. Mm-hmm. And so for me, from my perspective, how would I go about this? I'm selling those call spreads. Dylan becomes quite the play, because if you can collect some premium now in this market by saying that you're a bear, the market can continue to drift lower. Vol doesn't need to really expand much more from here for you to collect some healthy premium in this market. VIX is now up to 17.54. We haven't taken out the August highs, nor do I know if we will, but we're now in a place where option selling is a lot more appealing than it was just say a week ago.
What kind of durations do you like to look at, Chris, out of curiosity? I know that the tasty convention is 45 days, but I'm interested in, I guess it's a question for both of you, to the extent to which you like to sell spreads at any given point in time.
So there's two things for this. I'm completely agnostic to time frame. If it's 45 days or 90 days or longer than that, if I have a setup, particularly if it's macro based, macro is a glacier. It takes time to develop. You have to give yourself a lot of runway to be right often, because the market can stay irrational for quite a long time when you're thinking about, big top down trends. The other part of it is I try to avoid shorter term trading, years ago, and perhaps I've become smarter, more adept, more nimble over time. Although I'd argue I don't have the data to support that, only because I stopped a lot of my short term intraday scalping. A few years back, I bucketed out my results. How do my trades perform when I hold them for less than a day, less than 3 days, less than a week, less than a month, less than 3 months, 6 months, et cetera? And my worst performances were on the shorter duration trades. So I try to avoid them. And then you think about the tasty methodology, where there is a quantitative basis for operating around a 45 DTE, either rolling or exiting positions around 21, kind of right in the thick of the decay curve. it makes sense for me to operate that way as well. You have to give yourself time for the position to work, and you don't want to run it down to the end of the clock in case the market's moving against you. And all of a sudden, this position that you could have taken at least some semblance of a profit on is now going to be worthless. And you've just, wasted all this buying power for no reason.
It makes sense. I mean, because I am a macro-minded kind of market participant, my thinking tends to work the same way. I did an analysis on this, and my average winner takes about 6 weeks from open to close. My average loser is about 2 weeks. So I tend to run away quickly and try to keep my losses small. Once it's working, though, I like to let it run, because macro is one of these things that typically, to Chris's point, takes a while. So a 3 month, a 2 month window, so 90, 60, up to 45, but I'm not sure that I'd go much more inside of that. Just because
and then
what I do, it's going to take a while.
And then the obvious sort of, the conventional wisdom would be, you're much better, obviously, which Chris's point, to be selling spreads when volatility is spiking, as in today versus a week ago. But is there any other consideration? I'm just interested in terms of your macro, Ilya, whether it is, are you more likely to put it on through some sort of a spread, meaning short calls if you're bearish, or short puts if you're bullish, as opposed to being directionally long calls, long puts, even if those calls and puts are offset in some way through a spread to sort of manage the risk?
I tend to be more directional. So I tend to have a sort of world view that I develop, where I think, okay, here's, the baseline 5-6 scenarios for how I think the next 9 to 12 months might evolve, and what I look for to sort of get confirmation that the thing that I think is going to happen will. And once I get the price signals that I see, usually because some technical level has been cleared, or because the price structure has done something to, in a very simplified way, suggest that some sort of a turn has occurred in the cross-market relationships. I look a lot at how markets behave relative to each other. And so say, okay, what world are we in, let's say, if stocks are going up, but gold is going down, but interest rates are going up, but the dollar is doing X. So I look at a lot of that and say, okay, what world are we in that these things in concert are doing what they're doing? And once I get a sense that the markets are doing what I think they should, then I'll usually take a directional bet in whatever vehicle I think is the expression I want to have. In this case, for example, I've been long dollars against a basket of different currencies, rather than, let's say, go short equities. Because my sense was, well, even if I'm wrong on equities, or I'm early on equities, which happens to me a lot, the market tends to surprise with a risk-on stance where I'm looking for a risk-off one often enough, then I'll take a dollar bet, because it can benefit both from higher rates, which would happen in a risk-on scenario, but also from liquidation, which would happen in a risk-off scenario, and which is the thing that I'm expecting. So rather than go and take a bet in equities and end up sitting on it until it works, I'd rather take a dollar position and do it that way.
By buying calls, effectively.
Essentially, yeah. Mm-hmm. Or even just going out right into the futures or the spot markets. That can be very, very cost efficient when you're talking about something that's liquid like G10FX.
Mm-hmm.
I suppose my most successful time horizon, I mean, buy and hold has worked for me in a number of cases. Like, I first picked up Eli Lilly a few years ago when it was $80 a share, and I've just held on to that. It's funny because when I first watched Mr. Robot, which I just finished rewatching thanks to this writer's strike, they mentioned Eli Lilly early on, like, oh, it's an evil corporation that overcharges people for medication. And of course, they're known for their insulin hijinks. And politically, I think that they're absolutely awful. But if a company's political, from your political perspective, if you think they're awful, they're probably really well run, particularly if you're like a center left kind of person, as I've seen over time. Some of the most well run businesses, they're evil from a certain perspective. And it's because they're just ruthless capitalists and they make money for their shareholders. And Eli Lilly and the oil companies, big pharma, big oil, they all fit that motive. And so you have to set aside your political biases when you trade. If you really want to be successful in this market, when I see people, I'm going to short the market because of Democrats in office or Republicans in office. Okay, you're a mark. Yeah. You're clearly not that adept. Good for you. Thank you. Now I know to do the opposite of what you're saying until someone changes the occupancy of,
or just not to listen. Just don't listen.
Listen, we worked with a guy who had a very particular tendency when talking about trades. This is predating our time at Tasty, but we had a guy who we worked with who was particularly adept at calling the exact wrong move when he talked about trades over a very specific time horizon. And whenever he did, it was easy to go to the other side because you knew he was wrong. It was just like, this is one of those times during the day where the clock is broken and it's going to be right twice a day. But when it hits midnight, time to take the other side of the position for the exact time frame that he's suggesting it, because he just never gets it right. So I think that there are people out there who get emotionally wrapped up and have bad models of the world. You can use them as a sentiment.
That are actually a useful indicator to direction,
yes,
if it's in the negative.
Totally. And listen, I find that with myself sometimes where, even this past week, I always go back and I check my remarks when I do Futures Power over time and to kind of get a sense of how I'm talking about these things in real time. And then I look back a week later, a month later, matched up with the price action. It's like, okay, this is why I was feeling this way, and this was right, and this was wrong. And when I feel this way about this in the same exact circumstance moving forward, because I was wrong last time, I know that I should do the exact opposite. I call it the Costanza method, quite frankly.
This is one of the great benefits, by the way. One of the great benefits of doing things like this, of writing about markets, of talking about markets, is you have a record. And for those of our audience that don't have this outlet, have a notebook, have a Word doc, write things down.
Voice notes. Yeah. You can do dictation to your laptop.
You have to understand how you feel. Like it's, journaling, it's a diary, whatever, trading journal, whatever you want to call it. But at the end of the day, understanding why you do what you do and the reasons behind it and seeing if it's right or wrong, you build out that mental model of how the world works or how you think it works, and if you've made money off of that or not. And that's one of the most, you have to be self-reflective as a trader, which I think a lot of people take for granted. The people that are really, really good at this, you hear Tom and Tony talk about this all the time. Oh, back when I was in the pit doing this. Oh, I remember this happened in 1997. Oh, this happened in 2004, right? You build up that library in your head of past price action, past results, past market sentiment, and you get to the point where you're not making predictions, as we said yesterday. You're just simply reading the tea leaves. And well, when XYZ happens, or when the storms come in and the tree leaves start turning over, is it going to rain? Probably. So I should take an umbrella out today. And it's the same way in the market. That's just how it is.
I'm going to just flip this over from this. I know I have a proclivity for the macro. Ilya obviously is a macro specialist, and it's, my political commentary background, all of it lends itself to the macro discussion. It's also the most rewarding and all the things. But it does occur to me, as we move into, even if it's a brief period of selling, when you consider that the story behind NVIDIA, the story behind Tesla, the story behind Apple, the story behind Meta hasn't changed that much. And from a buy and hold perspective, if you're looking to, I don't know that it's now per se, but in these selling cycles, the accumulating more buy and hold positions in the mega names seems to be at least a worthwhile consideration.
And becomes a conversation about time scale, right? This is the perpetual sort of Burt Malkiel, don't try to outsmart the market kind of idea unless you're prepared to do the work and actually read and pay attention and learn. If you want to kind of be the kind of investor that doesn't have to think about this, that just wants it done somehow, the thing to do is to try to take the time factor out of it and just assume that you're going to hold these things forever and eventually they'll work, because you're absolutely right. None of these narratives have changed. What's changed is prevailing macro sentiment for the next, let's call it, year or two, maybe. But does that change the fact that AI is a revolution and these names are at the forefront of it for the next 10, 20, 30 years? Of course not.
But we're not talking about investing.
Right.
We're talking about trading.
Right.
Right. And that's a very different animal.
But I would say even from a trading perspective, I mean, look at what Tesla did last December. I don't know if you remember, if you were paying attention to Tesla last December.
I was, because I had buy orders in at 100. So when it hit $101 and I didn't get triggered, I felt all year long like a serious case of FOMO.
I mean, and so, I mean, it doesn't have to be the infinite time horizon for these names to go into the tank, in and out of the tank. Pretty quickly with this, because I was trading Tesla last year, buying puts or, put spreads, I guess it was. And they were paying, obviously, but I was also exiting much too soon, because in my mind, it was incomprehensible that it could go down, below $1.75 or whatever. I couldn't believe it broke 200. And I guess my point is, these names, even when they move down a lot, and I'm thinking specifically about NVIDIA and Tesla right now, become more interesting.
Well, one of the greatest sort of things that I continue to dog myself about forever and ever is, in early 2009, looking at the big money center banks in the single digits and going, well, there's still a recession. Now is not the time. What a fool.
To buy Citi at 6.
Yeah, like, what a fool. Like, that price is lower than the sum of the paper clips and keyboards and mice that they own across the various branches. Like, what kind of an idiot doesn't buy Citi in single digits? Where is Citi going ever?
Well, Lily, if you like Citi at 6, you're going to love it at 4 right now. Here in SMH, for what it's worth, Dylan brings up NVIDIA. Two charts really stick out to me during the sell-off, right? We've talked about KRE, we've talked about bots being a proxy for AI. Two of the leaders in this market, they always say like the generals are shot last. That may be the case, but they're getting bombed out with everything else right now. SMH, uptrend from this April low. That's lost here. You like horizontal support more, Ilya, so I put one here on the chart for you. Swing lows that we have in June and again in August. That's lost as well. When we're above this line, when we're in that area, everything is awesome. When we're down here, everything is terrible. I can point this out on ITB as well, because I have a lot of faith in the state of home builders in the United States. We are dramatically undersupplied. Millennials are the biggest demographic cohort. We need more homes. Plain and simple. We need more apartments, plain and simple. We cannot be a nation of renters. That's not the American dream. The American dream isn't to rent for your entire life and die and leave your kids nothing. But ITB here looks pretty ill. Uptrend from last year's lows in October. Again, swing lows that we have here in April, and again at the start of June. That was lost a few days ago. And Ilya, just for your sake, because I know that you like those horizontal lines more than the diagonal ones, we'll put one here on the chart. And what's happening right now? That's breaking too. So the generals in this market, housing, which everyone was saying this time is different. I was very much on board with the soft landing narrative all year round, because so many people were saying it wasn't possible. So my whole shtick was check the scoreboard. Well, end of July, when all the bears threw in their towel, we joked that was a sign of complacency and maybe that we're due for a bigger correction. Tell you what, folks, if SMH and ITB are performing this way, correction is here. It's happening. We're in it. Forget soft landing. I guess my question
would you be willing, sorry to interrupt you, Chris, but would you willing to go to extend that very narrative you were just articulating to starting to actually see transaction rates in the residential housing market actually start to happen here at, down 20, down 25%, down 15%?
I'll tell you totally something anecdotal. My wife's a real estate agent, both here in Westchester County and works out of Manhattan too. There were points last year and earlier this year where her clients, some of them were saying, I want to sell my property, but not yet because I want rates to come lower. And now she has new listings where the clients are saying, I'm very realistic about the state of the housing market, and I know it's going to be more competitive, and I will take the price that I can get. No longer holding out, which means that there's inventory turnover.
Which means you're going to maybe, again, clearing, right?
You mentioned this recently. Clearing. That's evidence of clearing. People are willing now to say, I will accept lower prices because I don't want to hold on to this for longer. I don't know if prices are going to rebound. I don't know when mortgage rates are going to go up. Listen, when we bought our home, our mortgage rate is right around 5%. And we looked at each other and said, we'll refinance it a year or two. I'm glad we got the home when we did because mortgage rates are 250 basis points higher now than when we got ours, right? But refinancing anytime soon? Probably no. But there is that mindset of clearing now that's coming into the market, which you have to think maybe that's unsticks things. Home builders.
It's a good thing it's happening where it's happening because Manhattan, Westchester County, that's expensive homes. You would think that would happen earlier because people would have seen more gains and would have said, you know what, let me lock this in now. You would think that would become more widespread over time. So there's probably quite a tail here for housing prices at a national level to come down once this thing spreads around sort of your more pedestrian markets.
But not only that, but I think like Miami, Southern California, like I would
Northern California, yeah.
It's are going to get Northern California, or those things are going to get swept. I think the whole thing goes down 20. I mean, I don't know what the trade is in any of that, honestly, but I think it's healthy to see, it's illusion is a sin.
I think the trade is after. I think the trade comes after. And
well, my next trade in housing, because I do want to get more into the home builders, but given the pattern here, it's about $10 range for the highs and the recent swing lows, and you could argue that left shoulder, some contorted head, right shoulder here, we'll call it about $10. I mean, that carries us down towards 70 or so, where we've seen previous price congestion this year. I would pick up more home builders at 70, but the fact of the matter is that my next trade in housing is going to be to litigate my property tax assessment. I'm in Westchester. I mean, I'm not even kidding. Like,
we're laughing because we know you're not kidding.
That's right.
I was fortunate to be born into a family where both my parents are attorneys. I will absolutely be using that privilege.
You're gonna be sending some letters.
Some very strongly worded letters.
Some strongly worded letters on regal with regal letterhead.
Oh, of course. Yeah. But I mean, look, getting back to the point, if we think about this market structure here, when the leaders lose their uptrends, you have to be a little bit more concerned in the short term. S&P is looking bad. Nasdaq's being bad. If I'm selling options in this market, we know that volatility and stock prices don't have a linear relationship, but there is a tendency that when volatility goes up, stock prices tend to suffer a little bit more.
For sure.
And so I feel comfortable. I feel more comfortable yesterday, definitely comfortable today, that if I'm looking at some of these things, selling call spreads for a directional short position allows you to collect some premium in the event that the market rebounds. It means volatility is coming out. So not only is there theta decay working in your favor because you are an option seller, you also then have volatility getting sucked out of the market, which is reducing the value of those options on the other hand. So that may be the play in the near term, selling call spreads. I don't really like, risk-defined trades are always good, like iron condors, what have you. But if you're trading this short, I'm not buying out of the money puts right now because vol is up and we've already seen the break. But selling call spreads, I will take the risk-defined trade in that regard I will take advantage of the inflated volatility here, because I go back to that VIX chart, gentlemen, and for us to get through 18, 19 here, I mean, think about the last times we were above 18 or 19. This is the regional banking crisis right here.
Yeah.
These are the peaks around fears of a U.S. default right into 20. So unless something really bad happens, a government shutdown is not going to do it. We were looking at the data today. You look back at the average of all the government shutdowns, the S&P 500 is up by 0.3% in the history of government shutdowns whenever they occur. And the average government shutdown lasts like 9.5 days. The regional banking crisis is still contained because the Fed's liquidity facilities are in place. So another bank can go under, but it will be absorbed by the system with relative ease. So in terms of things spiraling out of control right now, you're banking on some sort of black swan that's not in consideration. And I don't think we're going to get there, but vol gets up to 19 or 20, I think you're probably at a near-term ceiling unless something really gets unscrewed. And a UAW strike that gets resolved, that's going to help vol come down. Government shutdowns avoided, that's probably going to help vol come down. Other than that, we've seen a very sizable move here in the short term. So take advantage of it while you can. We know that vol is mean reverting, and getting through 20 is going to take a lot because we were only through 20 during the regional banking crisis. We were nary there when the default was potentially on the table.
Is the nature of black swans, though, that you don't anticipate them?
Well, of course.
So,
Ilya, I anticipate everything, so everything is a gray swan in my book.
Yeah. I keep coming back to the same thing I said at the beginning of this year before there was an SVB crisis, when I was talking about the possibility for some sort of credit stress and looking like an absolute idiot because it was definitely not happening until it was. We accumulated the equivalent of 2019 global GDP, about $90 trillion in public and private debt between the last tightening cycle ending and this one. So between sort of 08, 09, when we sort of went to zero rates, and the shallow rate hike cycle in 2014 to 2015, I don't put much faith in. We barely got anywhere until we ran away. Between the end of 08, 09 and now, there's a tremendous pile of debt that got accumulated through that period of very low rates. I find it very difficult to believe that when you raise rates like we have, at the speed that we have, that there's not anything at the bottom of the pool that is a malinvestment that goes bang, other than, let's say, something like an SVB mismanaging how much tech cash they had on their books. So we don't see it.
Forgive me, Ilya. Are you suggesting that there's hidden risk in the credit market, or
very much so? I think yes. I think the payment comes due eventually. I think we come
because all that low interest debt and the massive amounts of it must be rolled over at higher numbers, and for sure there's somebody in the mix who can't handle it, not just in Palo Alto.
Yes, and we have no idea where it is or who it is. I certainly don't. I mean, I'm not Michael Burry reading every mortgage prospectus. I don't have that kind of attention span. But just the sheer size of it all, and for how long rates were low, which is historically unprecedented in the modern financial era, how long we had rates that low. It seems like there is still something there that probably goes bang in the night eventually as all of this tightening really comes together.
Dylan, we need to close this out for the day and for the week. So I'm going to give you the final word here as I show VNQ on the screen. This is the Vanguard Fund's real estate ETF. It has commercial real estate in it. And if interest rates are staying higher for longer, this is one of those charts that tells me, okay, Stuff's about to hit the fan.
There's another day when we have more time. I need to talk to you about these lines because, as far as I can tell, you're just drawing lines. Okay, you draw the line however you want to draw, and then you just say you're like, this is a disaster. Look at this. But I mean,
that's why I like horizontal lines.
I could draw the line. I could draw that line 4 different ways and make it. But again.
More art than science, Mr. Ratigan.
No, I plead ignorance here. I have total. It's a different day. It's a different program. We have more time. I would like to understand the logic of some of your lines. Not that I'm skeptical of them, but only that I find it to be. It's not self-evident to me exactly what they're showing. But sure. I'll leave you with this. I loved selling call spreads 3 weeks ago. I really love it now. I mean, with that vol, because having the theta, having the directional benefit, which again, who knows, it's a coin toss on any day, even with this mess, it's still a coin toss as far as I'm concerned. But you do like having the fact that if you're directionally wrong, i.e. it's going up, you got the volatility compression offsetting your losses, and you have the theta. So I'm going to leave you with the Ratigan call spread to ponder, and we'll see how we're doing on Monday.
Ilya, as always, I know that I usually give you some time to talk about what you're going to speak about on Macro Money, which started 30 seconds ago. So I'm just going to wind it up here. Macro Money is every Thursday, Monday through Thursday, 5:30 Eastern, 4:30 Central Time. Ilya is also on First Call Sunday evenings, 5:55 Central. Nope, 5:55 Eastern, 4:55 Central. We're going to get this right the rest of the way. He's, of course, on Overtime here, Mondays through Thursdays, 4:30 Eastern, 3:30 Central. You can follow Dylan on Truth or Skepticism with Tom Sosnoff, Wednesdays, 2 p.m. Eastern, 1 Central Time, and, of course, here on Overtime as well. You can follow me, Futures Power Hour, every Monday through Friday, 1 p.m. Eastern, 12 Central Time. Ilya joins us on Fridays as the co-host, so be sure not to miss it. I guess it's the overtime of overtime, as it were, at the end of the week. Let me explain on Tuesday morning. Don't listen to this week's episode. We were all wrong. 9:40 a.m. Eastern, 8:40 a.m. Central. The Fed was a mover. Mea culpa, I suppose. In any event, this week and for the day, Overtime is out of time. We'll see everyone again on Monday. Hope you have a good rest of your week trading, a wonderful weekend. For Dylan Ratigan, Ilya Spivak, I've been Chris Vecchio. Up next, Macro Money with the man himself, Ilya Spivak.
See you there, folks.